On July 29th, SoFi stock did something incredible. It skyrocketed 18% on the back of a legendary earnings report. Investors were celebrating. The future looked bright. But just hours later, it all came crashing down. What happened? And more importantly, what does this bizarre chain of events reveal about the future of finance? This is a story of record profits, a shocking $1.5 billion twist, and a CEO who made one of the boldest claims in modern business history. To understand if SoFi is the next financial giant or just another hype stock, you need to understand the full story. And I promise you, the answer is not what you think. All right, let's start with the explosion. SoFi's second quarter results for 2025 weren't just good. They were a statement to Wall Street. This wasn't a small beat, it was a knockout. First, let's talk revenue. Analysts expected around $804 million. SoFi delivered a record $858 million in adjusted net revenue, a stunning 44% jump from the year before. Then, earnings. The street was looking for 6 cents per share. SoFi posted 8 cents per share, a 700% increase year over year. But here's the number that really matters. This marked SoFi's 7th consecutive quarter of GAAP profitability. They posted $97 million in actual real net income. For a fast-growing fintech company, that kind of consistent profitability is the holy grail. It signals that the business model isn't just a dream, it's a well-oiled machine. So where did all this growth come from? People. SoFi added a record 850,000 new members in just 3 months. That brings their total to over 11.7 million members. They also added 1.26 million new products, things like checking accounts, loans, and investment accounts, bringing their total to over 17 million. This isn't just a company selling one thing, it's building an entire financial ecosystem. The scale of this growth is just staggering, and it's a perfect example of the kind of information that moves markets. If you want to stay ahead of market-moving reports like this one, do yourself a favor and hit that subscribe button and turn on notifications. It's the best free way to support this channel, and you absolutely won't miss the next big story we uncover. So let's recap. Record revenue, record profit, record member growth. The company is firing on all cylinders. The stock should be heading to the moon, right? Wrong. In a move that stunned the market, right after releasing this incredible news, SoFi announced it was selling $1.5 billion of new common stock. Now, what does that actually mean? Think of it like this. A company is a pizza. The shares of stock are the slices. When a company does a stock offering, it's not making the pizza bigger. It's just cutting it into more smaller slices. So while the company gets more cash, each existing slice, each share, now represents a smaller piece of the whole pie. This is called dilution, and it's a word that investors hate to hear. The market's reaction was swift and brutal. The incredible 18% gain from the earnings report was completely erased in after hours and pre-market trading, as investors panicked about their slices of the SoFi pizza getting smaller. This single move created a massive debate online and on Wall Street. Was SoFi management being greedy, capitalizing on a high stock price at the expense of its shareholders? Or was this a brilliant strategic 5D chess move? I want to know what you think. Drop your take in the comments below. Was this a strategic move or a shareholder betrayal? I'll be reading through and pinning the most insightful analysis. So why on earth would a profitable, rapidly growing company choose to dilute its shareholders? The answer is simple. They're not playing for next quarter. They're playing for the next decade. That $1.5 billion isn't a bailout. It's a war chest. And it's designed to pour fuel on SoFi's secret sauce. A 3-part strategy that makes it fundamentally different from other fintech players. Part 1 is their superpower, the bank charter. In 2022, SoFi became a nationally chartered bank. This is a game changer. While other fintechs have to borrow money at high interest rates to fund their loans, SoFi can use the cash its members deposit in their checking and savings accounts. This is a much cheaper source of funding, which dramatically boosts their profitability and resilience. Part 2 is the engine, the Financial Services Productivity Loop, or FSPL. It's a fancy term for a simple, brilliant idea. SoFi attracts a new member with one great product, maybe a high-yield savings account or a personal loan. Once that member is in the ecosystem, SoFi makes it incredibly easy for them to adopt other products. Investing, credit cards, home loans, you name it. The Q2 report showed that 35% of all new products were taken by existing members. It's a digital flywheel and it's spinning faster and faster. Part 3 is the foundation: diversified revenue. SoFi isn't a one-trick pony. It makes money in 3 distinct ways. There's the lending segment, earning interest on loans. There's the financial services segment, earning fees from things like debit card interchange and brokerage services. And there's the technology platform, which provides back-end services to other companies. This diversification makes them far more stable than a pure lender or a pure broker, especially during economic turbulence. When you see that $1.5 billion through this lens, it's not a sign of weakness, it's a sign of ambition. It's capital to accelerate this very strategy, to acquire more members, build more products, and fortify their balance sheet for the long war against the big banks. This brings us to the single most important moment of the earnings call, a moment that perfectly encapsulates the company's entire philosophy. When asked about SoFi's incredible growth and record-breaking quarter, CEO Anthony Noto said, and I quote, "This is the worst we'll ever be. Think about that." After the best quarter in the company's history, the leader says this is the low point. This is the statement of a CEO who believes the flywheel is just beginning to spin. This is the core of the bull case for SoFi stock. The bulls see the bank charter, the productivity loop, and the fresh $1.5 billion in cash as the foundation for a new age financial empire. They believe SoFi is building a platform that could one day genuinely challenge the legacy giants like JP Morgan and Bank of America. They see a company that has achieved the escape velocity of consistent profitability and is now ready to scale to unimaginable heights. But there is always another side to the story. The bear case focuses on 3 key risks. First, valuation. Even after the dip, SoFi stock trades at a very high multiple compared to traditional banks, meaning huge growth is already priced in. Second, the economy. SoFi has thrived in a relatively strong economy. How will its loan portfolio perform in a prolonged, painful recession? And third, the law of large numbers. Adding 3 million members a year is incredible, but it represents a slowing percentage growth rate. Can they truly keep up this breakneck pace, or is a slowdown inevitable? The battle for the future of your money is being fought right now on the digital frontier. And with this move, SoFi has just armed itself for the long fight ahead. So, the SoFi stock story isn't just about a single day of trading. It's a masterclass in corporate strategy, investor psychology, and the future of an entire industry. You now understand the blockbuster earnings, the dilution twist that spooked the market, and the powerful secret sauce that has its CEO so confident about the future. If this deep dive gave you a new perspective and helped you understand the why behind the headlines, do me a favor and hit that like button. It's a huge signal to YouTube that you value this kind of in-depth analysis. And for more stories that go beyond the surface level news, make sure you're subscribed so you don't miss what's next. Thanks for watching.